The state of the global economy is headed for another crisis like the global recession of 2008 that hit all of the economies in the globe. This time, the issue is even worse and will have far-reaching effects. With losses totaling over $520 billion, the banking sector is currently experiencing a crisis that has caused significant instability. So let's begin today's video. Verge of a serious crisis, huge unrealized losses are putting the banking sector on the verge of a serious crisis. The term unrealized losses describes a bank's asset value fall that hasn't yet been recorded in the bank's financial statements. These losses are realized when assets are sold for less than their initial acquisition price. Currently, US banks are sitting on over $520 billion in unrealized losses, mostly because of rising interest rates, which have reduced the value of their holdings, especially US treasuries and mortgage-backed securities. In 2008, unrealized losses were over $60 billion. However, now, with a current total surpassing $520 billion, the banking industry is in a financially unstable situation. This issue is made worse by the requirement for banks to keep capital in order to withstand unexpected losses. However, based on the current size of unrealized losses, it appears that many institutions lack the capital necessary to withstand such a large financial blow. Interest rates and asset values. The increase in interest rates is one of the main causes of the significant unrealized losses. Existing bonds and securities usually lose value as interest rates rise. Banks that hold a large number of these fixed-rate securities see their asset values fall. This is especially problematic for banks with large portfolios of long-term securities, which are more vulnerable to interest rate fluctuations. Foreign central banks and de-dollarization. Another issue is the trend of foreign central banks diversifying their reserves away from US dollar-denominated assets and towards other assets such as gold. This movement, known as de-dollarization, diminishes demand for US treasuries, driving their value to lower levels. Consequently, the unrealized losses associated with these securities keep increasing. Regulatory and accounting practices. Current accounting practices allow banks to store unrealized losses in special accounts, which means they do not have to acknowledge them in their financial statements right away. Although this could offer some temporary relief, it conceals the actual state of the bank's financial status. To fully understand the intensity of the current situation, it is necessary to consider previous precedents. The 2008 financial crisis. The 2008 financial crisis was caused by a collapse in the housing market, which resulted in substantial losses in bank-owned mortgage-backed securities. The present crisis, which is the result of far larger-scale unrealized losses, may have far greater implications. The financial system was stabilized in 2008 thanks in part to government involvement, but the long-term recovery was difficult and took time. Future expectations. The future is uncertain, but multiple factors indicate that the crisis could worsen. The current trend of de-dollarization, coupled with economic instability and geopolitical tensions, has the potential to worsen the issue. Furthermore, the value of bank securities holdings would probably continue to decline if interest rates rise, which will increase the amount of unrealized losses. Such a banking crisis would not just affect the financial industry. Its consequences would spread throughout the economy and society, resulting in bank runs. As depositors lose confidence in the banking system, the risk of bank runs increases. In the event that several depositors take their money at once, banks may experience serious liquidity issues. Smaller community and regional banks should be especially concerned about this possibility, since they might not have the same resources as larger financial institutions to withstand such pressure. Impact on lending and economic growth. Banks that suffer huge losses due to liquidity concerns are likely to become more conservative in lending operations. This cutback in lending might have a negative impact on the whole economy, reducing growth and possibly causing an economic downturn. A serious financial crisis has the potential to start a long-lasting, severe economic downturn. Rates and monetary policy. The current crisis is heavily influenced by interest rates and monetary policy. Global central banks carried out extraordinary quantitative easing initiatives and dropped interest rates to all-time lows in reaction to the economic issues brought on by the COVID-19 pandemic. Although these actions contributed to short-term economic stabilization, they also paved the way for the current disaster. As inflation rose in response to pandemic-related supply chain disruptions and significant fiscal stimulus, central banks were pushed to raise interest rates quickly. The sudden shift in monetary policy had a significant effect on the price of long-term securities that banks owned. Bonds and other fixed income assets purchased at low interest rates saw their values fall as rates climbed, resulting in large unrealized losses that now threaten the financial system. The rapid pivot from ultra-loose monetary policy to aggressive tightening has exposed vulnerabilities in the banking system that were previously masked by low interest rates, regulatory failures, and the need for reform. The coming banking crisis also raises questions about the impact of regulatory improvements enacted after 2008. Even while steps like stress testing and higher capital requirements were taken to avoid a repeat of the 2008 financial crisis, the state of circumstances now indicates that serious vulnerabilities still exist. The way rules and regulations handle unrealized losses is one important concern. Under certain circumstances, current accounting standards permit banks to avoid recording these losses on their balance sheets, hiding the actual financial health of these organizations. Although the goal of this regulatory strategy was to avoid unnecessary panic, it's possible that it unintentionally allowed threats to accumulate within the system. However, as financial activities increasingly move outside the traditional banking system, regulators must adapt to ensure they can effectively monitor and mitigate systemic risks. Finally, in today's interconnected global economy, a banking crisis in one country or area can easily spread across borders. The unrealized losses of $520 billion that are threatening the banking sector are not limited to any particular country. Rather, they are spread throughout financial institutions globally. International organizations, such as the Bank for International Settlements and the International Monetary Fund, can be extremely beneficial in aiding collaborations and impacted nations. Also, the present situation highlights the necessity for regulatory reform. It is essential for policymakers to think about the development of a regulatory structure that is both resilient enough to prevent crises and adaptable enough to adapt to changing financial circumstances. Thanks for tuning in to another eye-opening episode on capital crimes, where we uncover the truth behind the dollars and cents. Before you go, fam, remember this: knowledge is power, and action is key. If you're as passionate about uncovering financial wrongdoing as we are, then don't forget to drop a comment below with your thoughts, smash that subscribe button, and share this video with the squad. Together, let's keep exposing the dark side of the financial world and keep chasing the truth.